so much for taking the time today to see my presentation of Seneca. It's really an honor to be able to present to you. And before we dive into the company itself, I think it's helpful to just give a brief overview of the industry in which Seneca competes, which is the private label canned vegetables industry. So in the early 1900s, this industry within the US was very highly fragmented, and you see increasing consolidation and overall increasing return on invested capital levels over time. So by the late 90s, it's a 4-player industry. By 2003, it's a 3-player industry. By 2020, it's a 2-player industry. And nowadays, it continues to be a 2-player industry, and Seneca has the most advantage of those 2 players. And my thesis essentially boils down to 4 parts. It's that 1, Seneca is a competitively advantaged company. 2, that it's misvalued due to surface level accounting complexity. 3, that the company has strong downside protection. And 4, that the company has significant upside potential. So here's the first point of that thesis, that Seneca is competitively advantaged. You can see this in 4 key ways. The first is that the company is very vertically integrated. And one example of this is the company's steel can manufacturing operations. The company is actually the largest self-manufacturing of steel cans in the nation, of any company. Also, you can see this in the high return on invested capital, 10.9% on average from 2021 to 2023. Also, you can see this from 2015 to 2020, when Seneca and Del Monte tried to battle on price. And even though Del Monte did their best to drive price down, Seneca's cost structure, which is much better, allowed the company to continue earning substantial profits throughout that time, while Del Monte lost a significant amount of money. And also you can see this in Seneca's dominant market share, 60% within US private label canned vegetables, and now the owner of both the second and the third largest brands of canned vegetables, non-private label. The second point relates to Seneca's surface level accounting complexity. So Seneca chooses to use LIFO accounting for its inventory accounting, and the main positive of this is it's allowing the company to save $80 million in taxes since this was implemented in 2008. However, there has been, because of the highly inflationary period we've been in recently, some distortion in how earnings appear. So because of how LIFO works, on a LIFO basis, earnings appeared very depressed, especially in fiscal year 2023. And also because these earnings appear depressed, it made the net debt to EBITDA ratio look very, very high, much too high, I think, for this type of company. However, on a more FIFO, which is more representative of the company's true earning power, in my opinion, the debt ratio looks very reasonable and the earnings look very reasonable.
Just so level set, is there a cash impact or not?
There's not a cash impact. And additionally, Seneca has very strong downside protection. It trades at only 1/3 of book value and even a 10% discount to net current asset value. And a lot of the assets are hard assets such as land and buildings, some of which are from the 90s and have been either depreciated in the case of buildings or continue to be marked at cost in terms of land. And so I think the book value underrepresents the true liquidation value of these assets. But nevertheless, strong downside protection. And looking at what I think is Seneca's normalized earnings, the company right now only trades at less than a PE of 4. And I think a more appropriate valuation would be a enterprise value to NOPAT of 9 times, which is a 7.4 times PE. And this has very substantial upside, about 90% upside. And I'm happy to dive into any of these assumptions in the Q&A section. And this slide, I won't dive into too deep right now because I think I've discussed all of these already in the write-up, but the main thing I would highlight here is the value-creating share buybacks of the catalyst. So in the last 15 years, before the last 4 months, the company bought back 20% of shares outstanding. Now management really sees even more of a discount to the company's intrinsic value, so they're accelerating these buybacks. 6% of shares outstanding have been bought back in the last 4 months. And mentioned, I've commented that they've historically overinvested in CapEx and expect lower CapEx investment in the future, which should increase free cash flow and should allow management, in their own words, to continue accelerating these share buybacks. Terrific. Well, as we see, Seneca is a company that has a competitive advantage. It's a company that has strong downside protection, and it's a company that, in my opinion, has significant upside potential. Thank you, and I look forward to your questions.
No, thank you. That's really great. The first question I had was, you mentioned that they're like a net basically, and they have like liquidation value. Can you just kind of walk me through that? What do you think? They do have some debt, right?
Yeah.
So like, how could you walk me through what you view as the liquidation value and how you're getting to that?
Yeah, so with the net essentially I'm taking the company's current assets and subtracting out all of the liabilities, both current and non-current liabilities. The only adjustment that I'm making specific to this company is I'm adding back the LIFO reserve, because I think without adding back the LIFO reserve, you're undervaluing the inventory on the balance sheet.
Okay, so you're taking the current assets, which is the inventory, the cash.
Yes.
And you're then subtracting out the debt and then current liabilities?
All of the liabilities, yeah.
Like all the payables
Yes.
and all that kind of.
Yeah.
And that you're getting to positive net assets?
Yes.
It might be helpful just to go back to
Yeah.
the slide. I also had questions
Sure.
about the 67% discount to GAAP book value, and you said GAAP book might even understate true liquidation value because of some of these assets. So could you maybe just walk us through that?
Yeah, so I think the book value calculation is how you normally calculate book value, and the only difference I'm making in that as well is adding back the LIFO reserve that you see up there, which makes the inventory be more accurately valued, because with LIFO will tend to understate the cost of that.
So you're marking up the LIFO inventory
Yes.
by 50%.
Yes, and also, and I'm not making adjustments for, if you look, they have a fairly substantial asset for buildings. It says builds and improvements, but essentially that's buildings and improvements, and that has been depreciated over many years. And I don't think that's representative of really the true value of those buildings, but I haven't made an adjustment there. So I think that part is conservative. The land, it's not that substantial of a portion, but some of this land that you're seeing is from the 1990s. And that obviously continues to be, according to GAAP, continues to be more at cost, where in reality, it's very likely that it's had significant appreciation.
The inventory is made up predominantly of what? Aluminum, like?
Mostly packaged canned vegetables, which have a.
So is that like the food itself, or
Yeah.
is it just the packaging?
It's the food itself as well.
It's the food and the can.
Yeah, exactly. The food in the can. This company is very vertically integrated. So if I just go back to, they have certain contracts with the farming, but they have their own seed operations, they have their own can manufacturing, they have their own logistics. And so basically that inventory primarily consists of canned vegetables, which have a very long shelf life.
So do you know the accounting treatment for inventory of, so this is maybe a little, in my experience at least, a little bit unique, but you have these can manufacturers like Ball and Crown Corp. They, for the most part, if memory serves, you may not know this, I don't expect you to know this, but they, the customers are responsible for the inventory, right? Like the manufacturer itself, they're basically they make the cans, they fill the cans, they put the labels on the cans, but they never actually take, the customer remains responsible for the inventory the entire time. Do you know how common this LIFO FIFO decision is? And do you feel like it's kind of like an own goal by management to have created this confusion in the marketplace? Or do you think it's fundamentally a smart move because of the tax savings?
So I think it's a fundamentally smart move because of the tax savings to start off with. And then the other question regarding, you're discussing the can. This company is very vertically integrated, so they have their inventory on the balance sheet. A lot of that inventory is their own private label. This company mostly, it used to contract with a company called Green Giant, which was the second largest brand in the space after Del Monte. But now, basically, this company recently, at a discount to inventory, bought that brand as well. So really now the company, it's even more vertically integrated, and they have their inventory on the balance sheet. I think that answered the question. If not, I would be happy to clarify.
I guess on some level, my question is, why are they so vertically integrated? Is it productive when lots of consumer packaged goods purveyors that sell things in cans actually are not vertically integrated? They utilize these big consolidated packaging companies that all they do is filling and packaging.
It's somewhat difficult to know because management does not host conference calls and they don't discuss that much about the vertical integration. It also may be that they don't sort of want to flag antitrust concerns and such, I would imagine. But I will say, even if that isn't providing a substantial advantage, which I think it is, because if you look at it, management has quite a substantial stake within the company, an economic stake. They have a 34.3% economic interest. So I think it would be unlikely if they thought that it was a drag on profitability that they would continue this self-operation, which they've done for a long time. But it's possible that it doesn't give a cost advantage.
They could be wrong, though.
They could be wrong.
They could be
that's
aligned but wrong.
It is true.
Yeah.
However, I do think if you look at the return on invested capital here, if you look at how the cost structure has compared to Del Monte, which at the time was the other largest overall player in the space, it does appear that the company truly does have a cost advantage.
I have one question. Just want to make sure I didn't miss anything.
Sure.
This presentation was different than what you showed us, right?
It's an abbreviated version.
I just for, in my own feedback, one, I learned a lot in time. I really like this presentation.
Thank you.
And I think in some ways it could have added to the kind of the understanding of a complicated story.
Sure.
So I thought you did a really nice job here summing up. This was a little bit denser and harder to get through. So,
Also, just on the, I don't know who, I know we had pre-read in the scorecards, but the scores should be done finally at the end of, so.
yeah. So I just applaud you on kind of taking this and then kind of moving forward.
Thank you.
On the valuation, we had a previous presentation that was on Petrobras, and we talked about some of the things that could hamper valuation, one of which was emerging markets. As I look at this story, there's kind of two issues. One, the voting interest is quite high at 54%. And the other is, it is a complicated story. And sometimes these things take a long time to kind of play themselves out. So can you talk about the valuation and what do you think are the catalysts to actually materializing to get to the 9.4 valuation that you use? How do you make your money in this? Because there are some
there's a couple catalysts, but really I think the primary catalyst here is those share buybacks. I think management have made it very clear that until the discount really dissipates, they're going to continue aggressively buying shares within the market. So I think that's really how that price to value gap will close. In terms of your concerns on management, yes, I do think it always raises some concerns when management have the majority of voting control. However, we've seen throughout the very long history of this management, I think this management has been in place for the last 30 years or so. And we've seen throughout that history that management have usually been quite beneficial to the shareholders, whether it be in terms of buying back shares at a discount, whether it be, their salaries are a little bit high, but nothing egregious in my opinion. They do have a little bit, I put in exhibit number 2, they do have a little bit of related party transactions, but the value of those is less than $1 million a year in my opinion. So I think management have generally acted quite fairly to shareholders and have generally been quite a positive for the company in terms of value creation as well.
Thank you.
Of course.
I had a question. In one of the risks here, you said faster than expected decrease in canned vegetable demand. So is this like a melting ice cube type business? Does it shrink? And then I know with if it's take an extreme like newspaper businesses, then weird things happen with evaluations that can make it tough. So is it I don't see the historicals here, but is it shrinking or is it staying pat, or how's that working?
It's somewhat of a melting ice cube. So if you look at the last 5 years per annum, the decrease in terms of units sold has been 0.6%.
Mm-hmm.
So it's in terms of the units, it's slowly decreasing. In terms of pricing.
0.6, is that per year? What's the units?
Per year, yeah. Per year,
So it's
0.6.
just below flat?
Yeah, just below flat.
And that's unit volume.
And that's unit volume. If you look at pricing as well, it's been 2.5% a year, or 2.6% a year, something around there.
Mm-hmm.
And so you've seen the net impact of that about 2% a year growth, inflation adjusted. But also
that's like the US canned vegetable?
Yes, and that's also the US canned vegetable industry as a whole. And also what we're seeing in that, although I don't have as much granular data on this, is private label taking market share slowly from non-private label. And this company primarily has exposure in private label. So it wouldn't surprise me if units sold, even though we don't really get this disclosure from management, is really about flat to slightly positive.
You don't know what the units sold.
I don't know,
is, so,
unfortunately, they don't.
You don't know, but no one knows.
Do you know what biggest selling products are? Like, is it just vegetables? Is it fruit also? Is it like tomatoes and beans?
So it's pretty much just vegetables at this point. About 80% of the company is canned vegetables. In terms of revenue, I think it's even like 82%. And in terms of profits, I would expect it to be significantly higher. There is a little bit of exposure through some other things that they've tried to develop a niche in. I think they're like the largest pumpkin sorry.
No, go ahead.
The largest like pumpkin canner now as well for private label and some other things. But they did used to be second in the canned fruit business, and basically Magellan made the decision in 2018 to completely exit that space because they saw that they were uncompetitive in that space. And yeah.
Let's also just let Porter get questions on. I know he's familiar with the company.
Well, I'll make a couple of comments then in question. You know, as a value investor, we've seen a lot of companies like this, right? And I understand completely why it trades what it is. The accounting sucks. It's not covered by the street. It's got no investor can have a controlling, any say of anything right on the board or anything because management has full voting control. They got kicked out of the indices, right? So they're not part of any kind of flows. It's small cap and it doesn't trade, right? That's a long laundry list of stuff. That said, as public investors, we can't do this. You would love the valuation here if you could buy this company, right? Because it fits in. I liked what you first started out. You used the capital cycle, right? Your first slide, you talk about, high competitors, low profits, no competitors, high profits. So I like that aspect. The question I would say is why now? And, the buybacks might help. I think maybe changing the accounting might help. The lower debt, I don't know that that's good. Like, again, the question is, why do we as investors need to own this stock right now? That's the biggest question. I think it's a hard question for you to ask, and I really applaud you for tackling this stock because it's a good one.
Yeah, thank you. I really appreciate that feedback. So the buybacks are much more accelerated now, I think, than they've been historically. And with I think there's an advantage where there's been this working capital buildup. If you look at their inventory, is much above historic levels at the moment. And that means essentially that they're going to have a working capital release, I think, within the next year or 2 years. And that in addition to the lower capex really means, in my opinion, we're going to see very substantial free cash flow generation within the next 1-2 years. And that free cash flow, in my opinion, if you listen to management's comments, is going to be used really aggressively to buy back shares. So yes, historically there's been these share buybacks, but I think it's going to be much more aggressive and in much higher quantities and pace now than it's been historically. And secondly, I think, speaking a little bit about my experience finding the company, if you screen for companies, which I think a lot of people do, then this company still at the moment appears to have, I think, somewhat, depressed profitability because you're getting part of the last 2 quarters, but you're also getting part of the 2 quarters before that where the gross margin is really low because the company reports on a LIFO basis and not all of the price increases have been passed through. If we fast forward to half a year from now, when people screen for companies, this company, if it stays at today's valuation, will screen on a very, very, very cheap last 12 months earnings, which isn't necessarily the case today. So I think we're getting ahead of that trend as well.
Well, great answers. Thank you.
That's a great
answer, yeah.
Thanks.
Maybe since this accounting treatment is so fundamental to the story here, could you just walk us through in detail the LIFO to FIFO conversion in your earnings power and, I guess, valuation calculation? Yeah,
sure. So there's 2 aspects. One, I think, just to clarify, are you talking more about the tax impact, or talking and how that impacts the valuation, or more about just general FIFO to LIFO?
I think it's really important to normalize earnings power here, right? And to do that, you need to convert from FIFO to LIFO
Yeah.
inventory in your gross profit. So maybe just walk us through how you did that.
Sure. I think the primary way that I did it is I looked, I think this is detailed in the article itself, is I think it's most representative to look at things on a FIFO basis. So essentially what I did is I looked at what I thought would be a year where we can really witness the impact of both the price competition that Seneca had with Del Monte and a year where we could witness the negative impact on margin on the gross margin from Seneca's fruit business, canned fruit business, which they've now exited. And so I went back to, I think it was 2018, and essentially took the margin from fiscal year 2018, the FIFO margins, I think that's more representative of reality. And I added back to it the percentage of gross margin that was lost at the time from the canned fruit business. And then also added to it, I think it was, if I remember correctly, 60%, something around there, of the price increase, the pricing which Del Monte took in the industry when they decided to exit the price wars. And the reason for that is on the non-private label side, Del Monte is really the key player. And really now, I mean, Seneca controls so much of the pricing that Del Monte doesn't control. It's basically Del Monte with the #1 branded canned vegetable brand, and then the Seneca controls now both the #2 and #3 players, and they control the majority of private label. And so I think that they are able to implement a substantial portion of the price increase, which Del Monte took, in my opinion. And then I arrived at what I think is the normalized gross profit margin, and other things such as SG&A and such I annualized from the last year, I think it was, from the last quarter, I annualized something around there. And then essentially I had to take into account the discount they're getting in the tax rates from FIFO to LIFO. So essentially looked at, on their current revenue base, how much more earnings would they actually report if they were reporting things on a FIFO basis rather than a LIFO basis, and essentially said on this portion they're not actually going to be paying taxes, and this is the tax rate I think they're actually going to be paying.
Okay, thank you for that detailed answer. So 15% gross margins in FIFO. Do you mind just flipping back to the LIFO margins you had for the calendar years? Sure. Okay, so it is, all right, so so you're seeing the uplift in Q1 and Q2 of the financial year,
Yes.
You average, okay, I see. Okay.
And my estimate would be 14.9% on the FIFO basis. So if you look at Q1 and Q2, they're actually substantially exceeding that so far.
When you spoke earlier about the working capital buildup, that is fundamentally an inflation story.
For capital buildup in the inventory, you mean, or in the CapEx?
We were talking about working capital building up and then the subsequent free cash flow release that you expect.
Yeah, so there's two things there. One is what I mentioned, they've historically overinvested in CapEx. So going forward, there'll be less CapEx investments, and that's in management's words. And secondly, a lot of companies, including Seneca, both Seneca, Del Monte, they basically misjudged how much they would sell in fiscal year 2023. And because of that, they have a substantial amount of inventory buildup. And we've actually seen this as a very recent, but Seneca released their last quarterly report, so Q2 of 2024. They released it this past Friday, and units are down by about 10%. And the reason for that is because all of these players have built up inventory and they need to destock. So for example, Green Giant, which up until Seneca recently bought Green Giant, they're #2 in branded canned vegetables. They have this contract agreement with Seneca, where Seneca provides them with actual canned vegetables, and then Green Giant just labels them. And Green Giant ordered substantially too much last year. And because of that, basically, we're seeing a temporary decrease in demand.
Fantastic. You do still have a few minutes. I know you started late, but you've also been very efficient with your time. I noticed that you highlighted the CEO changed in 2020, which is also somewhat correlated with some of the inflation, which has destabilized their earnings power from a GAAP basis. What's your impression of the new president and CEO? How was he selected? What is his background?
Yeah, it's a bit difficult to know because exactly, the exact perceptions of the new CEO, because again, there's really limited disclosure of the filings.
Where did he come from?
He came from inside the company. I don't have it's in the write-up, I just don't have the exact details on the presentation itself. But it says, I think previously, I believe he had some executive role in the company itself, and it's difficult to sort of find background about him before that period.
How long has he been with the company?
I think he was since.
Like just ballpark.
Yeah, I think it was like since 2017 or so. I don't remember exactly. It's in the write-up though, yeah.
The brands that they control are Green Giant and what's the other one?
I'm blanking on the name, but it's like the third largest.
I'm just like mentally walking down the
Sure.
supermarket aisle trying to think. And like Green Giant has a frozen vegetable business, but that is not.
They have no association with that.
Only.
And they actually are still paying like a small royalty to Green Giant for the name. But it's definitely a value, just to stress, it's definitely a value creating acquisition. I mean, Seneca bought this asset from Green Giant for less than the value of the inventory alone, yeah.
And is there like no spoilage of inventory because it's canned?
Yeah,
Or, like,
it's
like,
very, very long shelf life. I think conservative estimates put it at 5 years. Some of this stuff though is like
I've seen
decades.
people eat like this stuff from World War II.
Exactly, yeah.
do you know when canning of food was created?
Yeah, it was created by Napoleon actually for his army.
That's right.
Oh, you really did some deep work.
I thought I was gonna stop you.
I think we should call time, but yeah, that was very clearly articulated and well presented.
Thank you so much.
It's a fascinating, it goes back to, it's a fascinating idea. The question of, is it the right price, right? Because it's super cheap. Is it the right time of the cycle? Or is it the right time, is it a great business? And obviously it's not a great business because the top line is not great, but can the right price and the right time of the cycle overcome that? And so anyway, I just really thought it was an interesting idea, well-researched, and a great job.
Thanks so much, I really appreciate it.
Did they get, this may be too obscure, but like,
Sure.
did they get, like, at the beginning of COVID, for example, like, is there any observed history of consumer behavior of like people stocking up? Like, is there something about canned food in particular was like, it can last forever and it doesn't have to be refrigerated, and so you could see a scenario where like consumers are like, oh, you know what, like I'm gonna buy out the store because it's hurricane season.
Yeah, there was definitely a stocking up during COVID. Things are back to normalized levels now, not only in terms of the amount of canned vegetables people have at their home according to the company, but also in terms of the number of units the company is selling. So yes, there was a overstocking that affected things somewhat, but now we're back to normal trajectory.
All right, thank you very much.
Thanks so much, I really appreciate it.
Thanks, Itai.